Ken talked about, this is usually something I review with my partners every week. Actually it's a little bit more connected this week with our speaker because that is Scott Painter, who is not yet here.
He's here.
Oh, is he? Okay, fashionably late. Scott and I worked together at Idea Lab about, I don't know, 12 years ago. And so some of what I'll be saying will probably relate to some of the things he's going to say. So maybe I'll give just a slightly different take on venture in this one. First of all, though, something that's been going on for the past 10 years or so in the economy, and we're talking worldwide, has been a shift from equities to bonds. And for guys like us, venture capitalists who, of course, only do equity, really there's no debt, that could be a troubling sign. I mention it because I was reading some reports this past week from a couple of investment banks, what they call the cult of equities starting to decline. And it is interesting when they refer to it as a cult, because from about 1910 to 1930, equities were really exciting, and a lot of people got into them. And of course, we all remember 1929 and the stock market crash. From about 1930 to the mid-50s, equities were considered something to be avoided at all costs. As it turns out, equities had pretty good returns during that time, but anytime you have a really, really negative experience, usually you try to avoid that. As venture capitalists did to a great extent after the bubble burst, and a lot of VCs, I think, missed out on some terrific opportunities in consumer internet, which was the one place in 2001 that no VC wanted to be accused of investing in. And this is almost always the case. But here's some stats that I found quite interesting. So in 1950s, mid-50s, the large pension plans, who, by the way, really are who dominate the markets, right? They're the ones who own most of the equity worldwide. They owned of their portfolios, about 20% were in equities. The vast majority of the rest were in bonds and commodities. That's mid-50s. By 1999, it was about 65% of their assets were held in equities. And by the way, if you want to understand why, and actually there were a lot of Johnny-come-latelys, even in 1980, the percentage was maybe 35%, was because if you invested $100 in the S&P 500 in 1950, that would have been worth about $58,000 by 1999. If you invested $100 in government bonds, it'd be worth about $1,500. What's fascinating is since 2000, if you apply that same statistic, that same rule, what you get is about a 4% return in global equities from 2000 to 2010. And by the way, that's really China and India and Brazil. It's negative in the US. And it's 103% return if you invested in the debt of governments. And when you hear about the problems that government debt is in now, and all of the worries that we're debasing our currencies, you can kind of foresee that there is at some point going to be a collapse in that. And either money will get pulled out and sit in cash and commodities, or it will go back into equities. Another interesting stat along this line, the Japanese were particularly against equities for a long, long time, post-World War II. It was held by a very few number of people. By 1989, the Japanese stock market, which had had about an 8-year run, was worth 50% of the total world market capitalization, which is fascinating. And I always love this one stat about land. The Emperor's Palace in Tokyo, the land underneath it was worth more than all the real estate in the state of California. And in the city of Tokyo, that land was worth more than all real estate in the United States. And the funny thing is, while that was going on, I remember reading that this was the case, but it didn't matter. And this goes to that cult. At this point, of course, equities in the United States have had a very long painful, 2 bear markets, 1 near-death experience. And so what's recently happened is all the pension funds who invest in venture capital have started to say that they're going to reduce their exposure to equities, including the most risky equities, which is venture capital. Now, to put things in perspective, there's whatever it is, $20 trillion worth of market capitalization in the US, and venture capitalists put about $6 billion a year into early stage companies. So it's very, very small. But still, it will be affected, and I think affected negatively. Going on to some company information, we've talked a lot about Netflix over the last couple of weeks, months. As you guys all saw, they're now up to 9 billion market cap. Someone wrote that 20% of all streaming, all bits streamed during prime time are streamed to Netflix, or from Netflix. And two things strike me about that. One is, if you are an old line broadcaster, that should worry you. And the other is, there is this problem, call it free riding. Maybe not necessarily real free riding, but you've got Netflix, which is a website, which has signed some content, licensed it, it didn't make it, and it's benefiting from an all-you-can-eat pipe that all of us have signed up for, including FiOS and some of the bigger pipes. So at some point, I think they're going to have to start sharing that revenue with the guys who've invested that $250 billion in the pipes. Another interesting company that also came out this week and rolled into, really roared, Apple. It gets, like a lot of things nowadays, there's a very narrow segment of companies that we all talk about. Apple, of course, probably being number one. But there's a lot of rumors about Apple ultimately getting to $1,000 a share. And I saw some analyst on Wall Street do a quick and dirty analysis and say, all that would take is for them over the next 5 or 6 years to grow their profits 30% a year. Now, personally, I think that's really, really hard, because you're talking about almost recreating Apple's profit base 2 times over by 6 years. And they've already done a really great job. But there's not a consensus, but there's a lot of belief that they're going to get there, which is why the market cap hasn't slowed.
But do you realize that 60% of the $20 billion that they raised, or they made in the last quarter, was from products that did not exist 3 years ago?
Yeah. I've talked a lot about this, but there is no other company that I've ever seen like Apple in terms of the pie chart of products. If you look at where they were 5 years ago in their pie chart of where the revenue's made up by product, look at it not just from 5 years ago to today, but look at it by year. That pie chart like changes 20%, 30% swings. So that is, of course, one of the reasons why they're a fascinating company. But if Apple hits $1,000 a share, its market cap would be the equivalent of 7% of US GDP. So it's hard to imagine they're that productive. But one of my partners pointed out we should look at what Cisco was, which was another stock that had the same sort of craziness in 2000. It was 5.8% of GDP when it was at almost $600 billion market cap. And 10 years later, it's at $120 billion market cap, even though its revenues have gone up 4x. So you all know what might happen with Apple. It could go either way.
Wall Street Journal reported that the iPad is the best-selling gadget of all time already.
The iPad.
Yeah.
Already.
Wow.
Yeah, what I read is there are going to be projected 45 million iPads sold in 2011. Now, the thing that's interesting, though, is you look at